Ladies and gentlemen, good day and welcome to the Agro Foods Limited analyst call for the Q3 FY23 financial results, hosted by Anand Rathi Share and Stock Brokers Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phones. Please note that this conference is being recorded. I now hand the conference over to Mr. Ajay Thakur from Anand Rathi. Thank you, and over to you, sir.
Thanks, Jorvin. Good afternoon, everyone. On behalf of Anand Rathi, I welcome you all to Q3 FY23 results conference call of Agro Foods Limited. From the management side, we have Mr. Sachin Gopal, Managing Director, and Mr. KPN Srinivas, CFO of the company. We are going to start with opening remarks from the management and followed by the Q&A session. I shall request Mr. Sachin Gopal for his opening remarks. Over to you, sir.
Okay, good. Thank you, Ajay, and good afternoon, everybody. As usual, we'll walk you through the presentation which has already been uploaded, and then we'll take questions after, right? So thank you for joining us once again, and we'll start the meeting without delay. All right. So on the second slide, you'll see company vision really to become the best performing, most respected foods company in India, and we certainly believe that we are right on track to be able to get there. In terms of the Q3 key performance highlights, the overall headline is we've seen a steady food growth. It's not been a strong food growth, it's been a moderate food growth, but it's been steady, and we've also seen improving margins, right? So we delivered foods revenues of about 116 crores. This represents a growth of about 7% versus prior year. I think a diversified portfolio has helped us to achieve the moderate growth that we have delivered because we have multiple lines. Otherwise, if it's just a ready-to-cook business, it would certainly not have been able to deliver this. So that, speaks volumes for having a good portfolio. The key thing, however, is for us to be able to get the RTC, to overcome this RTC base impact, which is a very big base. It's almost double of what it was, a couple of years ago, right? So there's been a huge lift in our average sort of monthly selling rate, right? Almost double. But the thing is, that's already in with us, and we need to figure out, how to continue to grow it so that we are on track for our overall, 20% growth in the food business that we'd like to have. So we'll talk more about it today. Staples margins, I think, are holding up well. Year to date, we have had a gross margin of about 53 crores. Prior year for the same period was about 55 crores. So that's good. I think there was a lot of questions at the time the Ukraine war had started. But overall, I think we've kept a fairly clear priority in our minds in terms of gross margin, on the margin versus volume choice, and that has played out reasonably well. So there has been a cost in terms of volume, and we'll refer to that and come back to it later. During the last November meeting, some questions many of you had asked, can you just share a little bit more about, in terms of the reading of the results that we gave in terms of, what is the overall profitability of the food business. So we don't do any segmental reporting, and I don't think we're also going to have the scale in the near term to, which necessitates it. But we have provided some information today to you. What it does is it's giving the breakup. So you'll see, there's a net sales. This in the first row. In the second row is gross contribution. So that's net sales, less raw material, less packing material. Yeah. So that will correspond, when you look at the P&L that we published, to less cost of material consumed, purchases of stock in trade, and changes in inventory of finished goods and stock in trade, right? So if you do the match, for example, on the total company, you'll see we've got net sales of about 225 crores. And then if you will, you adjust it for, or from it deduct the first 3 rows of the expenses line, it will give you a figure of about 78 crores, right? So that gives you an aggregate gross contribution for the company of about 35%. Now, the aggregate, however, is very divergent when it comes to the individual categories, right? Foods is now a little more than 50%, 50 to 55% of our business, roughly, depending on which quarter you look at, right? So half our business is running at about a 24% gross contribution, right? That's the staples, the entire staples business. Here we are not differentiating between premium staples and mass staples. And the foods business, and that's the good news, is now back to our historical 45% level. So we used to be at 45, 46%. gross contribution levels. At our peak, we probably even crossed 50%, right? Where there was a very high share of our ready-to-cook business, right? And 50% is kind of a benchmark, right? There are companies like Nestle who are probably at around that level. And the 45 to 50% range is good, is the right range to be in if you want to have a 15 to 20% EBITDA margin, right? Because then, depending on what your mix is, let's say if you are able to control all your costs, which is SG&A, manufacturing costs, advertising and promotion, damages and leakages, transportation, warehousing. If you are able to control it at 30%, you'll make a 15% EBITDA margin with a 45%. Conversely, if you have a 50% gross contribution, then you'll need about, you can probably have even 35%, all these expenses within 35% to make it to the 15% EBITDA margin. So we will give you a visibility of this from now on, right, in terms of how is the gross contribution tracking on the food business, because this will be important for you to know, okay, are we headed in the right direction? Because at the end of the day, if we have a GC in the range of 45 to 50, I think we're okay and on track for that 15 to 20% EBITDA margin that we want from the business. Okay. With good margin visibility, A&P investment we increased in this quarter. It's up by about 2.6 crores versus prior year. You'll see this later also in our competitive spend charts. And this is also will help to address the ready-to-cook growth. We are spending on ready-to-cook from about 1 crore a month to 1.5 crores a month in December. We're doing that in January as well. And we will continue to invest so that we get the ready-to-cook business to, the between 10 and 15% growth, so that in aggregate, if the non-ready-to-cook business grows at about 25 to 30%, and this grows at about 10 to 15%. In aggregate, we are delivering in line with our historical CAGR of about 19% or more. You'll see a change of about 1 crore in this P&L due to in employee benefits. That's largely due to hiring. Okay, so we have hired more people. There are more people on the ground, more feet on street in terms of supervision, right? So all of those, it's largely accounted for by that. And in other expenses, there's about a 1 crore increase versus prior year due to higher travel, right? So travel is getting normalized. We are restoring it to earlier levels. Still not fully there, I would say, because cost of travel is very high, but we are making a gradual progression towards that. And as a consequence, as you can see, profit before tax and profit for the quarter, profit after tax for the quarter are about 9.3 crores and 6.8 crores respectively. So those are the high-level comments on the P&L. We'll be happy, obviously, to answer any questions that you have later. The next chart that we have is performance highlights by category. So, we are already familiar with it, the 5 food categories and the edible oils category. And now come to the ready-to-cook snacks category. As you can see, we continue to have about 5% or lower volumes versus the prior year, right? Which in our view is largely due to the COVID-19 base impact, right? Elevated level of media investments have been initiated for popcorn starting December, as I mentioned earlier. These will help us to get to the desired levels of growth in FY24. Establishment of the rupees 15 price point for instant popcorn is underway, supported by retail demos, and you'll see more of this if you go in the trade. Rollout of pizza and pasta sauces has commenced, and development work is underway for broader snacking kits portfolio to support the whole RTC growth in FY24. And that includes plant meats, which we talked about earlier. Okay. The next category is ready-to-eat snacks. Here, as you can see, we continue to have strong growth. It's about 40% up in volume and about 50% up in value. But as you can see in quarter 3, the gap between volume and value has narrowed down, right? So that decrease has happened because we are starting to lap periods which contain price increases in the prior year, right? So going forward, you can expect that value and volume will start to better mirror each other. You may not see so much of a gap between the two, right? Sweet snacks, which we talked to you about last time, are starting to gain momentum. That's really Caramel Bliss and the Sundrop Duo Crunchies. And actually, the impact of greater scale in ready-to-eat popcorn, the increased share of sweet, and a greater absorption of overheads by breakfast cereals is significantly enhancing the profitability of ready-to-eat snacks. So, for those of you who will recall, who either met us or you asked a question in the calls, we have always, our position has been that ready-to-eat snacks is the conveyor belt of the company. This is what's going to carry it, and we have seen that. In areas where we have plants for ready-to-eat popcorn, where we are able to service the distributors there in a close proximity, our coverage is much, much better than in areas which are distant from the plants. So, So I think this is critical for us in terms of our coverage expansion, right? And the only thing that always has been at the back of our mind is, how we'll be able to actually make this category profitable, right? Because at the end of the day, EBITDA margins on RT snacks are lower than they are on a category like chocolates or ready-to-cook products, right? So, but the good news is that we are, I think, getting closer to finding that answer. We've seen a significant jump this year in terms of profitability, helped by each of these three factors, right? So this is good, and therefore we believe that everything is right now, meaning that we should be in a stage where all of this conveyor belt, if you will, is self-funding. So it's not eating into resources that we would otherwise need to require to build the other four categories in terms of media and other promotion activities. So we will continue to drive both the scale of the savory and the share of sweet. This is absolutely right, and going forward, it will remain a good direction. But it's a satisfactory outcome as we see it for the first 9 months of the year, and it seems like it's very much in place. So that's good. The next category is spreads and dips. You can see here that we've still got a fairly steady volume performance, right? And as we mentioned to you about more than a year ago, maybe 18 months ago, we felt that we had lost some share or were losing share in the segment. We think that whatever share we had lost, we have more than regained, if anything, gained a little extra. And we've also therefore been able to, increase our share in many segments, right? We have modern trade data where, we do get data from our customers, and it shows that, we are absolutely solid in terms of a share position. And in fact, from the data that we've seen, and I think almost any share that Unilever has taken has been from the other players, right? So only yesterday we were in the trade and looking, and one of our older competitors was out of the store, and the number of players physically available is now reduced. Our assessment also is that new competitors are struggling to find relevance, right? So in a sense that we are there, we've built the category, we're in very, very strong share. And both large FMCG players, you've all seen the Unilever investor meets, right, results, right? And the charts. And even the DTC players are really, really, really struggling to find relevance in the category. So I think it is evidence of the moats in the food business. At the end of the day, the food business, one of the reasons it's a great business is it's got very good moats, right? Consumers don't move so easily away from you, and you are able to, therefore, have a very, very, very strong share position. So I think we're in a very different space from where we were 18 months ago. So all looking good. We started the rollout of the new high protein variant, which is Peak. It will take its time. We have to go through the process of distribution expansion. It will have to be supported by things like gym detailing, like say, oral care companies do doctor detailing. We have to do gymnasium detailing, talking to people in the gyms. So it will be a slow process, but it will be a very, very effective process. And over time, therefore, we expect to establish the Peak brand name, not only specific to peanut butter, but establish it as a high protein offering, and therefore it will lend itself to many other areas like granola bars and so protein bars, so on and so forth. We also expect going forward that the gap between volume and value to narrow as we lap the prior year price reduction in peanut butter, right? So this is the quarter four is the quarter in which we started we started rolling out the lower prices of peanut butter, and that's why you've seen there's almost been a 1,500 basis gap in terms of value being lower than volume because of that price reduction. We are now past that stage, right? Because the base will correct itself. The gap, I think, in say a month like January will probably come down to about only 2 or 3% in terms of net sales per kilo, right? And then, so you would expect that in quarter four, I think you should expect that the gap between the two will decrease, and therefore next year we will be projecting probably a value growth ahead of volume growth, right? Because now that we've actually got taken care of our share position, we need to focus also on margin improvement. We've written out a gross margin check to be able to defend our position in the category, but that's done now and it's all settled down. Some work we'll do on margin improvement. This includes some pricing, which is underway, which is work in progress right now, supported by a greater focus on higher margin SKUs. Obviously, we'll keep an eye in terms of our total share of the category, but we feel that it's in good shape and therefore merits this improvement. And we will continue to build chocolate spreads and dips. These are small categories for us, and they will take time, but we will keep nurturing them as we go along, so that each of these categories individually in the next few years can get to about 20-25 crores, so that at that stage you don't have to look around for new things to do. We already have the categories in place. That when we have more advertising resources, and which we will, as gross margin and foods becomes better and foods become a larger part of the business, we will have the money to be able to invest in these categories. Okay, next page is on breakfast cereals. As you can see, the numbers looking very good. Expansion of center-filled cereals and rollout of value-added packs, oats ensure strong category growth, right? So we are up 54% in volume and 54% in value. There could be a few pieces movements here in the sense that we are taking some amount of pricing in some of this where we feel we have headroom for pricing, but there will be new if you will, variants, let's say value-added oats which come in at a lower revenue per ton. So how exactly it balances, I'm not able to say precisely right now, but broadly got and value will be in a certain range within each other. The center-filled cereals are really doing very well. You can see that if you go to the competitive spend charts, you'll see that Kellogg's has spent money and Tata Soulful has also spent money, which is good news for us, right? Because we are riding it, and it's one of the reasons for very, very good growth, because we have a great product, right? So that's good. And we've introduced a cookie and creme variant, which is with the launch of Oreo, there has been a taste establishment in India of cookie and creme, and the product is very well accepted. So we've been retailing it now for maybe 2 to 3 months now. We also have another product which is a bit like the Kellogg's Choco, so that's what we call shells. So we've reworked this product and it's being rolled out now to improve our bottom of the pyramid offering. The earlier product we felt was a little hard and needed to be corrected. And this will support broad-based growth by the time we start advertising center-filled cereals. The center-filled cereals along with Duo chocolates is they are the two candidates for advertising support as we see the margin opening up, which is evident even in this quarter. So that will be a strong candidate for receiving some media support. But at the time that we advertise it, center-filled cereals cannot reach a 5 rupee slot. It's not possible. The number of pieces is very little. So the shells product has to do the work. So it was important to rework this, and I think this is also being done. That way, when we advertise the franchise, we get the benefit on center-filled cereals, and we also get the benefit on the shells product, which is available at a lower price. Overall, very strong momentum. You can see, driven by very high quality offerings. Our products are excellent, and I think you can ask anybody that, and our products are simply outstanding. We will continue to focus on volume growth, including distribution and on-shelf presence, to improve category profitability through operating leverage. So, as I talked to you earlier in the context of ready-to-eat snacks, there's a lot of overhead that is currently being absorbed by the breakfast cereal line now. So with volume, we should get the benefit in terms of both the fixed costs and in terms of depreciation, and therefore see an improvement. That is the work we have. It's just that we need to time the advertising and so on and so forth, how to be able to get the best benefit. Okay. The next slide, if you can just go to, is chocolates. We've had definitely less than desired growth in this category in quarter 3. We struggled with the optimization of simultaneous production, packing, and shipping of multiple SKUs, and this was really not completed during the quarter. We got a second line, and there have been challenges out of Germany, as all of you know. Germany has struggled. It was there in the Hershey's call also, the global call, I think about a couple of months ago, where they had talked about it, because Germany is the primary machinery supplier for chocolates even to the United States, right? And they're very good at it, but they've had challenges. The country's got challenges aside from energy, labor shortages, etc., etc. So we installed the second line, but there have been still some challenges on this effectively scaling up and having a very good rhythm in the plant, right? So we are working towards establishing the required supply chain for the category in Q4. Q4 and Q1 anyway are good times to do it, because starting February, March, then the weather temperatures go up, and therefore we need to be a little careful. Everybody's volumes also come down a little bit. Obviously, year on year it doesn't matter. but it's there. So it gives some breathing space to the plant. We are also, as we told you earlier, looking to establish an almost 100 crore plus capacity in Jagadia. So all that work will be underway, and I think we should be able to therefore use the next few months between now and then the monsoons occur, and then the next season starts to be able to close this piece. Okay, we've had an excellent response to retail display initiatives wherever we've done that, which really confirms the validity of this growth lever in the large and profitable chocolate confectionery category. So as we mentioned to you, we are going to test the limits in this category, see up to what point we can get with display, but without spending significant amounts of media, because we want to focus our media right now on the ready-to-cook category so that we are able to get that growth rate, right? And so we will rely quite heavily on display, and the category responds very well to it, so there's no problem, right? So only yesterday, I think I was in a store here, and we had one almost between 15 and 20 secondary displays of chocolates in that store, and even in the main category, I would say we had a good couple of shelves. Very nice, despite the fact that some of our offerings are small in size, but overall excellent position to be in. Steady shipments have also been established in the important gifting category. Gifting is an important category for chocolates. It is a convenient category to give, right? And so it takes a little while to get it right. But I think we've got now a couple of gift packs which are very good, and they can handle high temperature, high moisture conditions quite easily. So we are happy with that. The key work right now that we are doing is really capacity. We need to work on expanding the capacity. We need to work on increasing the productivity, right? Because we need to establish what are the right processes. How do we get the exact output in each part of the line? These are all just technical details, but this has to be done, right? And also automation. There is a lot of labor in chocolates and secondary packaging, and we need to automate that to the extent that we can. So that work is also underway. So in fact, I think probably next year as we deploy our capital expenditure plans, probably there'll be more investment in automation than we've probably done in the earlier years, as we are trying to scale up and therefore reduce our manufacturing costs. Okay. In terms of staples, that's the next page. In premium staples, you can see volumes are down minus 15% and value is down 10%. This is really for the quarter, and aggregate is about 12 and 6, which is probably you can treat the aggregate as representative of in an overall context for the year, right? Individual quarters may vary a little bit. So this is really the cost of being focused on margin. We are very focused on margin on staples, and from a margin perspective, we believe we've done well. We've lagged the downward slope of the pricing probably a little bit, but not too much, right? And therefore, we're okay. We've come out well, I think, through the entire Ukraine war, and the consequent volatility in the market, right? And mass staples really reflects the exit from Crystal, because there is only one month of this quarter where we had Crystal in the prior year. So starting quarter 4, there will be no Crystal in the prior year. So you can expect that you will not see this kind of negative starting quarter 4, right? We are also working on the execution to make premium staples more broad-based, right? This is underway. This will help to provide procurement scale, and possibly also, as we are finding, as we are starting to do more, reduce the total cost of manufacture for the foods business, right? So we are not making any investments in staples. We don't do that in edible oil also, but we do invest in packaging machines at our third-party event packers plants, in our partner plants, because those packaging machines are specifically for our laminates and our packs, right? So we don't intend to do any capital deployment in terms of manufacturing on processing on these staples. If we are buying oats, we'll only be using, let's say, bring it into our plant, pack it, and ship it out. But each of these elements is helping us to reduce will help us to also give scale to the plants, right? So this is, earlier we had talked about procurement scale, but what we are also seeing is it will probably help to get us lower overall manufacturing cost, and that's good for us, right? Because obviously a big part of our margin improvement is going to be focused on how do we reduce the cost of manufacturing, right? And the more broad-based we can make it, the better off we are. So that's a interesting side development. Rollout of oats has started, and you'll start to see our oats, and it's doing well. And also staple items are also under development. Here our focus is always going to be, as we told you earlier, items that we are already buying, but where we see the benefit of scaling up, right? meaning instead of getting smaller quantities, if we get full truckloads, then we see a corresponding reduction in price. This happened in oats already, right? And it's going to probably happen in a couple more categories. And as we do that, we therefore improve our margins in the food business across the board. So it's really a nice balance of foods and staples, and we'll see how to continually optimize it. Mass staples, as I mentioned, reflect largely the exit from Crystal in FY22. So the key thing really here is, and this is not just true for us as a company, it's true for all people in the food business. The more pricing everybody has taken in FY23, and in the US it's pretty common, you'll see companies where you've taken maybe 15% price increase, you had a 8% volume drop, it's possible, right? Or, it could be different, you took a 10% price increase and you had a 5% volume drop, right? What is going to happen as everybody enters FY24 is your revenue per kilo is likely going to be lower than what it was in FY23, right? Because FY23 saw a significant increase in prices. This is true for our premium staples business as well, and even for mass staples, right? Where FY23 has seen an increase in price, so your revenue per kilo has gone up, and then you are exiting FY23 at lower revenue per kilo as compared to your peak in FY23. If that is the case, then it's reasonable to assume that unless there is a significant change in global demand patterns over the last 12 months, your average revenue per kilo on some of these staples, or anything for that matter, is where you've taken this kind of pricing, is likely to be lower next year than it is in the current year, right? And depending on how volumes play out, how many consumers come back, how many don't stay, you do need to have a plan to be able to offset this revenue. It doesn't really represent a margin risk, because margin, as you've seen in these staples business, is not necessarily correlated with volume. It's correlated in the long term, but not necessarily in the short term. So we are working on plans to see how with these additional staples making broad base, we are also able to offset the revenue impact, so that in total we are able to do a good, a reasonable job from a total P&L perspective. All right. So if you can, the next is comparative update. I'm not going to spend too much time on this because I think I've talked a lot right now. So you can see pretty much on snacks, you can spend more time on the charts later, but there's a visible shakeout, right? With money becoming tighter, a lot of the actually fringe players are just cutting back now. People who come into the category on an opportunistic basis, right? And it's really spending is now just 6 players, when we actually looked at this chart. So if you see the 6 players are Agrotech, you can see Frito-Lay, you can see IDC, you can see Cracks, which is DSM Foods, you can see Pratap Snacks, and 2Yum, right, which is very steady in terms of its investment. But other than that, everybody's a bit they come in, they leave, right? They're just fringe players, right? And I think we are going to see more of this shakeout in other categories as well, because as money becomes tighter, a lot of the other people who came in because there was easy availability of money will simply not have the resources to be able to last it out, which is good news for a company like us. Go to the next page, it is spreads. So again, you can see Unilever now in total spending almost about close to 100 crores on in rack rates. Their own cost of buying will be a little lower than that, I'm sure, given their scale. But that's a fairly significant amount of money. And as you saw, they were not able to reveal their national share of peanut butter in their call. So it really means, I think, we come out very, very well out of it. And again, spending dominated by long-term players. So the fringe players are exiting, right? You can see that very visibly in peanut butter. You can see that even in honey, right? The people who came in and said, oh, by the way, we'll do a great job and enter, leaving gradually. So again, same as the snack story. If you look at it, right, just step back for a minute and you say, yeah, it seems to make sense now that it's only the long-term players who are going to who are committed, who've set up their own manufacturing and who've been investing consistently in their brands over a period of time, who are now actually going to have a very, very good sort of runway ahead of them. Okay. Breakfast cereals, again, fairly similar to last period. Kellogg's continues their broad-based supports. Nestle has discontinued support, so they came in, but they really haven't spent any money last year or the year, this year or the year before this, right? And whatever they have, I think they have. And Tata is investing some amount of money, and we are happy with that because they invest some money on Centerfield along with Kellogg. That's good for our business because we honestly have very, very good product. So it helps us to build up, to that 20, 25, 30 crore levels that we want and need to be able to invest behind media. Okay. In chocolates, if you see, It's again just the major players, but they are all spending consistently. Cadbury is certainly doing that. So is Nestle. So is Ferrero, and so is Mars and Hershey's. But all, I would say, pretty much dominated by multinational companies, right? And that's good for us because they operate with very, very high margins, and so the margin table is very high, and we have therefore a lot of headroom in terms of pricing once we are able to get the scale that we are looking to get. Okay. Edible oils, you can see we've not really spent money for several years. The interesting thing is the mass oil share of spending is really increasing and increasing. So, we've always had this row called track brand, but if you look below it, you'll see others. Others are all the regional brands. And you can see now at 800 million for quarter 3, which is 80 crores, out of 137 crores, more than 60% is by all the small brands. So it's not even that the other national players, the lower priced national players are actually having a dominant share of voice. They are also coming down in terms of the share of voice. So this reinforces our position always that, this is not a category that we should spend money on, and we took the right choices several years ago to invest our resources behind the food business. I'm not going to spend too much time on the other charts, the noodles, the pasta. I think there is some amount of shakeout which is visible even in noodles. So I'm going to just continue noodles, pasta, soups. You have the data, you can compare it with earlier periods, right? Not much change. In sum, therefore, if you can just go to the last page, which is quarter 3 and year-to-date summary, I think we've largely navigated commodity inflation without derailing our volume trajectory in foods. Right? At the beginning of the year, we were very concerned that, with this kind of a commodity inflation, if we make the wrong moves on pricing, could it derail, our overall growth story? And I think we have a moderate year-to-date growth of 10%, and that's, I would say, not really due to any pricing. That is, we are, in fact, if you see our revenue per kilo on a month-on-month basis, we are exiting in a very nice manner on the food business, right? So that next year we can seek improvement in revenue per kg and also seek good growth in line with our normal expectations. And work is underway. The one thing we need to address is the base impact of COVID on RTC volume, which we are underway. And, moment you sort of understand something is a priority, you work on it. You saw that on peanut butter. We took whatever action we needed to take, and we got our volume and share back. So this will happen. Of course, in this category, we are the largest part of the category. So media starts to become a play role, and we'll see what are the levels. Because at the kind of distribution levels that we are, media is really the most critical thing to be able to drive customer expansion. Oil margins are stable despite the impact of the Ukraine war. Excuse me. The higher margins have come, however, at a cost in terms of volume, and you've seen those volume charts earlier. And therefore, planning is underway to address the consequent impact on next year. Right. So we need to have all the right actions in place so that we do the right things strategically, right? But we have adequate time to plan and execute them. So obviously, oats is one part of our expansion into premium staples. But there are a couple of other products also that we are looking at, which we are already buying. And they say, oh, okay, I think this could be a good option for us. This will fit well under our brand. And by the way, if we buy this in bulk, instead of paying 190 rupees a kilo, we'll pay 150 rupees a kilo, right? So that works beautifully, right? You get a procurement scale, and then when you pack it at your plant, you also get some manufacturing overhead absorption. Foods margins are recovering to pre-COVID levels with expectations of further improvement in FY24. So you can see that it's bounced back, and the gross contribution is a good measure, again, north of 45%, and we expect to see further improvement. And a diversified food portfolio clearly helping to ensure a steady, sustained, and profitable growth. Yeah, okay. So I think that's pretty much it from my side. And, Shri, anything you'd like to add? No? Huh? Yeah, so I think we are on our way to becoming the best performing, most respected foods company in India. Not there, but on our way. Okay, Ajay, over to you, man. Cheers.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Percy Panthaki from IIFL. Please go ahead, sir.
Sir, 2 questions from my side. Firstly, on the gross margin, so basically as it is reported in your SEBI format, your sales minus COGS is what I'm looking at. And if I look at the gross margins over a 10-year period, they are roughly flattish. They might be range bound 200 basis points here or there, but roughly flattish. And in this period, we have hived off or materially reduced crystal exposure. We've also increased food salience very materially. So all these benefits really, I mean, why are they not showing up in the gross margin line in any material fashion? That's my first question. And of course, the corollary to this is that when do we see it showing up and to what extent? The second question is, what constraint do we need to address if we have to push up our foods growth from a high teens kind of a consistent level to a 25% kind of a level? Because given the scale at which we are and the amount of new products that we are launching and their contribution or what their legitimate contribution to the sales that it should be, it seems to me that 25% growth would be a more sort of suitable kind of a growth than a high teens kind of growth. So just wanted to know, what do we need to do in order to sort of get that kind of a growth? So these two questions from my side, sir.
Thank you, Percy. Thank you. And, they're both, as usual, very good questions. So I'll try and answer them to the best of my ability, okay? So, see, on gross contribution, which is, yes, as you correctly said, net sales less, the first three rows and other expenses. It would, I don't, meaning I will not be able to confirm or...
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला आहे. कृपया लाईनवरच राहा.
Hello?
Yes.
Sorry, I think I got that or you got it. Something happened. I thought maybe Ajay is upset with me and doesn't want to hear my voice. Okay. So, all right. So I'll not be able to confirm the exact figure like the trend for 10 years. I'm sure you've done your homework and it's correct. But I'll tell you, here's the deal. See, if you look at it over a 15-year period, okay, our gross margin, and I think I published this in one of the annual reports, when we started the journey was in the region of 60 to 65 crores, something like that, okay, for the total company. That time foods was only about 2% of the business, right? Now, in this 15-year period, and somewhere around maybe in the 7th or 8th or 10th year of the journey, you'll be able to see it in that graph, in that annual report. We brought up because of oil's pricing, we took up the margin on oils to almost 145, between 145 and 150 crores. Okay, right? At the same time, oil was building up, 5 crores, 10 crores, 20 crores, 30 crores, okay? Now, what happened as a consequence that with that pricing, there was obviously price elasticity, right? Therefore, we entered a period where actually the premium staples were declining in terms of volume, right? And that is when, therefore, we took the opportunity, if you remember, 3 years ago, to do the price correction. So, if you look at this period, in 15 years, there's a part where we took up pricing of oil and also food margin was growing, but food margin was not a big contributor, right? Then there was a second part where oil margin was kind of flattish stroke declining, right? Now food was continuing to build, okay, right? And then the margin actually on oil, as you know, if you look at last 2 years data, is in the region of about 70 odd crores, right? And we have also told you that that is the level at which we think it can reasonably settle down, 70 crores plus minus, right? So, the reason why you are seeing the data and your analysis is showing that, and I'm sure the analysis is correct, is that you're looking at a period when oil's margin was being compensated for by foods. Foods was growing, oil was declining, but foods was not able to offset the decline in the oil's margin, right? So in aggregate it was flat. But now look at it at the end of this period. 15 years ago, 99%, 98% of our margin was coming from oils, right? That was in the region of, say, 60 crores, right? Today, 15 years later, the aggregate margin has gone to whatever it is, about 170 odd crores or something like that, in that ballpark. But now the dominant part of it is coming from foods, right? So, with this is what we commented on earlier also, is that now that this has happened, that transition has happened, we have to see a growth. It's going to happen. It can't be stopped, right? Because even if there is a risk in oils, you can say no, but there is a risk. The materiality of that has come down, right? So with oils making 100 crores plus margin, I think I've given the number in one of the earlier calls or reports of in the region of 110 to 120 crores. Once the dominant part of our margin is coming through foods, it will grow. But mathematically, this is the period where you saw a replacement of oils gross margin with foods gross margin. Okay? So that's the answer to the first question. The second question is, what constraints do we have to overcome? So I think Shirish had also asked this question Monday, and he said, Sachin, but you should be going at 35%, exactly the point that you made. And the answer is yes, we'd also like to go at 35%. In fact, when we do our capacity planning, we do our capacity planning working on 30 to 35%. Because we actually don't know in these 5 categories. We may postulate and say, okay, I think I'll get this growth in this category in this year, but it may not necessarily work out. That's why you want a diversified portfolio, because we never have the forecasting accuracy to say accurately for all 5 categories how is each one of them going to grow. Something will do well, something may not do well. Some assumptions may hold good, other assumptions may not hold good, right? So we certainly do our capacity planning on that basis, right? And after that, frankly, will be largely a function of how much money we have in the P&L. And as we mentioned in our third chart, the better once we have good margin visibility, then we will invest more also, because we need the bottom line also, but we also need the brand investments, right? So we'll certainly do it. And if you see, for example, for the last few years prior to this, our advertising spends had come down, right, to about I think maybe 4 to 5% or something like that. But now, if you see the last quarter, the advertising spend will be in the region of about 6 to 7%. So I think advertising is key. We will be you can influence categories up to a point with the up to maybe 30, 40, 50,000 stores. You can influence it with retail contact, right? We built the popcorn business like that. The first 50,000, 60,000 stores were all built. But let's say a brand is now, available in close to 300,000 stores. You are going to have to rely on a little more media, right? And I mentioned it earlier, if you remember, I said that, innovation is a large part of our business, but innovation share will come down over time because the bases will become so big. So that's what we are working towards. And let's see, even we would like the 25, right? But we don't want to pursue a 30 or a 35% one year and then fall flat the next year. Okay, we are not going to do that. We are not going to say, oh, by the way, let's spend so many $1 million and this change will occur. It doesn't occur, right? Foods is a business which is built over a period of time. The best example of that is, don't look at our business, look at Hindustan Lever's peanut butter. It's visible to you, 100 crores and single-digit share, with single-digit share. So money is not the answer. And that's why it's such a great business, right? Because nobody can just come in, spend money and, eat your share of the cake. Okay? So thank you, Percy, for asking both very strategic questions. Thank you, Bottom. Happy New Year.
Thank you.
Okay.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Broking. Please go ahead, sir.
Yeah. Hi, good afternoon, Sachin. Thanks for the opportunity. 3 questions. I think extending from the previous participant, and I don't recollect exactly, but maybe about 5 years before we had this interesting conversation that you set up a target, not exactly the target, but we had the discussion and you said 40 and 50. When we reach about 50% food portfolio, we should be aiming to get 40%. Now, I'm not sure whether we reach there, but I need to check because now we have a significant portfolio which we have developed. So where do you think, what are the hits and misses and what can come up in next, if we need to fix, where we can expect the gross margin to move non-staple portfolio?
Okay.
Second question is on high protein peak. Maybe if you can share some on-ground details, where it has gone, whether we have gone only in e-commerce or modern trade, and what kind of opportunity in 3 years we are seeing. And third, on the staples, what we learned that Saffola has dropped the 5 liter and prices, and this they are giving a good competition to the other players. So have we taken any pricing correction in the quarter which is gone by, or maybe in the month of January on the Suntop portfolio hat?
Okay. Thank you, Shirish. All very good questions. So I think to answer your question, what kind of gross contribution do we expect on the food portfolio? I think we are already, as I've shown in this table, at about 45%. We see a 48, something like that, 49 maybe even, but in that ballpark, right? As something which is doable, right? This will come largely due to a couple of reasons. One is, as we invest more in media, we'll always definitely be able to hold more pricing power. Second is, as we get procurement scale. I gave the example just now of a staple, right, which we are currently buying at 192. As we have it coming in the scale, it's come down to 150. So there will be pieces around this. There will be also benefits coming through in terms of packaging material as we get more scale. Single SKUs become larger, right? We have some of those SKUs already visible to us. Where our partners, our packaging vendors, they can also drop the price because they get bigger runs and longer runs, right? So each of these pieces is going to contribute to this. And that, as I've said earlier, is a very, very good gross contribution to work on, right? Now, how does this translate from a profitability perspective into EBITDA? That's where that 30 to 35% piece comes in. How do we have all our costs, right, in that region of 30 to 35%, depending on whether we are at 45 or 50% in terms of gross contribution, right? So that includes advertising, that includes transportation and warehousing, that includes our SG&A, that includes manufacturing expenses. I would say we are pretty well controlled already today. If you look at the size of our business and you look at our employee wage bill, we are probably very, very good in terms of our SG&A structure, right? I mean, I'm sure there must be somebody who's better than us, but I think we'll be probably, in the top 3-4% in terms of SG&A control. I think even in terms of A&P, we are very tightly controlled. We have always told you we'll manage this A&P within 7 to 8%, and I think that's where we see us and ourselves, and we are getting the results, right? We'll probably get some benefits of scale in transportation, but we don't see those as being the full game changer, not more than 50, 100 basis points, because we're already, like, for example, in bag snacks, shipping full truckloads to distributors. Okay, you can say, okay, if I get more scale, I'll get a better price for, each of the lanes that I do reverse auction in. But I would say that would be limited. The biggest size of price in the chain has to come from our manufacturing cost, and that will come with scale, right? And a lot of people have asked me this question over time, saying, "Oh, Sachin, so what is that scale? How do you define it?" And my answer has always been, and over the many years, and you would probably have asked me this question earlier, when you say, okay, at what level will ready to cook popcorn be a very profitable business? And I told you that probably 15 years ago, 200 crores, right? And I'm sticking by it. We can already see the business. It's in that ballpark, and it's got the right manufacturing cost structure. So I think as each one of these categories starts to get closer to 200 crores, they will all get scale. It will fall into place, right? Today, the manufacturing cost on some of the categories will be very high. It will be very high. And the reason is we simply don't have the scale in those categories, right? So in category after category, we are seeing that. All right. In terms of high protein peak, the opportunity is large. Look, protein is a large opportunity. One of our directors who's also on the board of Parag was telling me, for example, that, they're looking at about a 200 crore business on whey protein this year. So that's a large business, right? And, and you can see Muscle Blaze and all these other guys. But the thing is that I think we are not going to be just a protein player, right? We are not going to be if you will, focused on only protein. I think we will be playing in the area where there will be more blended protein. Okay, so it's all work in progress, right? So where you have some amount of plant protein, some amount of vegan protein, and some amount, let's say, of dairy-based protein. Okay, and we'll work around it. It's very, very early days, Shirish. We think it's the right thing to do, right? And we also think it will lend itself very well to things like, as I said, protein bars, right? And protein bars are going to be a big thing in India someday, right? Not necessarily now. It's still a small business, right? But we are just working on that, and we'll keep you briefed. But it will take time. Okay, no. In terms of staples, yes, our competitors have reduced prices, and I think we naturally it's an area which we track, and we will also deal as appropriate, right? The only thing is I would like to reinforce to you that specifically for the competitor that you called out, our focus is margin. We need the margin, and then we do the best possible job in terms of volume. Okay, right? It is not that we are going to do volume at any cost. We are not going to do that, right? Because for us, the role of the portfolio is different from other companies. Our competitor A may have one role, competitor B may have one role. I'm not saying that that's right or wrong. It's right for them. But for us, the role of the premium staples category is to provide us that a sustainable margin. So obviously, you can't have volume continually declining and say, oh, by the way, my margin is going to remain stable, right? You need to be able to shore it up in the right manner. And we've done that in the past, right? You saw when we did the price correction 2 years ago and significant, we got a lot of volume, right? So, we were able to arrest that volume slide, if you will. So it's okay. But I would not like to compare ourselves in our actions to what our competitors are doing. We will do what is right for us. Okay, and that doesn't mean it's wrong for them. It just means it's wrong for us. Okay, we respect them. They're all competent people. So that's it. Thank you, Shirish, and happy New Year, man.
All the best.
Thank you. The next question is from the line of Ajay Thakur from Anand Rathi. Please go ahead, sir.
Hello, sir. Just had two questions from the investors and wanted to get them addressed. So you have mentioned about the gross cost contribution this time around, which actually excludes the direct manufacturing cost. It only includes the raw material cost and the packaging cost. So just wanted to get a sense what would be the like-to-like gross contribution margin if I were to look at for the current quarter versus the past few quarters.
Okay. Anything else?
Second question was more on the can we get a broad share of each of the food subsegments? So like for instance the RTC, the RTE, and the spreads categories, so on and so forth. What would be the broad breakup of those in the food segment?
Okay. So first question then on gross contribution. I think, Ajay, basically, historically from, this obviously, we are giving this information to you in response to the questions that were raised in the investor meet, would have been in a ballpark, pre the commodity inflation was 45-46%. Okay, right? So that's why we feel that we are in the right space in terms of gross contribution, because as I said, and I was doing the maths, and I could be wrong, let's say for next year, but I think the figures I saw were 52 and 30, right? 52% gross contribution for the business and 30% cost of sale. So that's why we think this 45-50% is a good range, and historically it would have been the case. This would have dipped only in quarter one of this year, when the commodity prices hit us, meaning this period, in and around quarter one, immediately before and immediately after. But by and large, it's a very, very sustainable level for us. In fact, we would have some opportunity for growth. So I was with our chairman again yesterday in the trade, and he was comparing, let's say, our pricing with, let's say, in the chocolate category with Nutella, or our pricing in peanut butter vis-a-vis a Kisan, or our pricing, I think it was, let's say in breakfast cereals versus the Kellogg's. And his comment was, you've got a lot of room for pricing, I said, yeah. I said, we'll take that pricing, that headroom. And it's significant, right? It's like a 30% difference. I said, we'll take it, but in many of these categories, we need scale, right? So we need to attract the consumer to us, okay? We are not going to attract the consumer to us today if we go with the parity pricing, because he'll say, okay, then, there's no reason for him or her to move. They're already happy with their current offering. So we need a reason. We've got the reason. It's profitable already. It's at 45% plus, right? So we think we have enough headroom in each of our categories, and chocolates also would be a similar case, right? Enough headroom in the future years as time goes by to get closer to the 50% mark rather than being closer to the 45% mark. Okay? So this is not a new number. The number is there historically. It's just that the question was asked and we wanted to put it forward in a transparent. It's an answer to a question. That's all. Okay, but we will do it and we'll report it to you regularly, and you can do the math yourself. You can do the math looking at our P&L, and you'll know that it's all kosher. All right. In terms of share, honestly, we don't buy any retail audit data. Okay, so I can't give you any share, but I can tell you wherever we get data from our customers. Our modern trade customers, they do share the data with us, and I can tell you, for example, that in ready to cook popcorn, we will be 90-95% share. In ready-to-eat snacks, also in modern trade, it would be quite good. I don't remember the last time we got the number on corn snacks, but I think it was in the region of 8 to 10%, right? And on spreads, I would say in modern trade it ranges between, on peanut butter, it would range between 60 and 70% with the customers in modern trade. Okay, but we think that in traditional trade it is lower, and therefore we've always given you, we quoted a Euromonitor figure in the region of about 40%, and I think that is reasonably correct. In breakfast cereals, it would vary depending on the category, but I would say in center-filled cereals in the modern trade, we'll probably be about a third of Kellogg's center-filled cereals. But in traditional trade, the ratio would change dramatically. And in fact, that's why we always say in cereals as a snack, I think we are the clear leaders, right? And if you will, and on chocolates, it's brand new, but so it's a 15,000 crore category, so we have a lot of scope. But I can tell you, for the customer that I was with yesterday, probably we have a 3 to 4% share of the chocolate category in that customer. Okay, so that's the kind of data that is available with us. I wish I could give you more. Maybe one day when we have more money, we'll buy new audits, or we'll just say, you know what, it's okay, it's better to let the money flow down to the bottom line, because we got used to managing without data quite happily. All right? Okay. Thank you.
Thank you.
I guess the last question now. Yeah, last one, and then we can close.
The next question is from the line of Chirag Maru from Keynote Capital. Please go ahead.
Yeah, thank you for the opportunity. First of all, thank you so much, Sachin sir, that you have provided some clarity on the gross profit contribution from the foods, and it has been highlighted in our financial highlights. One thing I would like to know is, like, if I am looking at it correctly, if contribution from food business is around 45%, I'm seeing that our food business is doing about 30 to 32% gross margin. And the increase in gross margins for the current quarter is majorly driven by the oil business, which is currently doing around 38-40% gross margin for this quarter. And I have generally seen the products that we are in food business, they do a gross margin of around 40 to 50% general range. And currently we are at around 30%. Just wanted to understand what are the steps we are going to take to bridge this gap from 30 to 40%. Will it be more related to the pricing of the product, or will it be more related to reducing the cost of the manufacturer? That is question number one. Second question is, as you have suggested that the product is getting well accepted in the market, the newer SKUs or newer products that we are building, how is the production getting ramped up at our manufacturing facilities? And third question is more related to the accounting thing, where I'm able to see that pre-COVID our other expenses was in the range of 15-16% as a percentage of sales, whereas now it has gone up to around 17 to 18% range. So is it because of the product mix, or is it there are kind of one-off expenses that we are incurring in this particular year? Thank you.
Okay. Sorry, Chirag, one question. On your second question, I didn't get it yet. You said something about production or products. I'm not sure.
Yes, so it was related to if we are seeing a good acceptance of our products that we are manufacturing, related to peanut butter, maybe related to chocolates, maybe related to sweets. If we are seeing good acceptance, I just wanted to understand how the ramping of this production of the particular product going on. And as we are expecting that food business would grow at 18% rate, just wanted to understand if we are able to produce that much amount of products too.
Okay, got it. Thank you, Chirag. Okay. All right. Happy New Year to you too. So first of all, in terms of the food, the answer is both. You said how is the gross margin, which is gross contribution less all the direct costs, right? Which is the manufacturing costs and the transportation and warehousing and the damages and leakages. How will this grow? Will it be due to cost of manufacture, or will it be due to pricing? The answer is both. Okay. So as we scale up, right? Because remember, at the first level is gross contribution, right? Which is what all of you asked the information for. Which thank you for pointing it out. That will come through pricing and procurement. Okay. At a high level, if our margin is going to improve, it needs improved pricing, And that's, as we've talked about, there's a lot of headroom. You yourself have commented, right? So we've got headroom on pricing, but we'll also get it through procurement. As we procure better, we scale up better, those costs will come down. Also, our manufacturing costs will come down per kilo, right? Our manufacturing costs will come down because, we are now producing a much larger volume on a large part of the capital that we've already deployed. I'll come to a little more detail on that, okay? So, I would say both of them. We would expect to get more in pricing, but we would also expect to get a lower cost of manufacture, and add to that the fact that we would expect more procurement due to scale, right? The one example I gave you of the commodity, and maybe that's a commodity that we enter in 6 months to 9 months time. But that is how we see it. Okay. In terms of the products, and yes, as you said, and I've also emphasized that the acceptance of our product is very good. How do we ramp this up in production terms? So what happens is that, look, we have spent maybe, let's say, 400 crores on setting up 6 to 7 plants, right? And we've entered 5 categories. That's a very small investment, right, in terms of the sheer number of categories, okay? Right? Probably if it was one of our larger competitors, they would have spent that much money on just one category alone. So what we've done is we set up a plant, right, and then we install all the right machinery, right, the first stage of machinery that we need. But then we don't spend so much money on the upstream management of that production or the downstream management of the production. Okay, so I'll give an example. Let's say we have an extrusion product, right? And we, let's say, put in an extruder, we put in an oven. It is possible that the oven we'll install will be twice the capacity of the extruder, right? So initially, right now, because we're deploying with very limited capital, making very tight choices, we'll say, okay, let's go with one extruder. The moment we get the scale, we add in a second extruder. So our incremental capital is not on the entire line, it's just on the second extruder. And if the oven can handle 3, then we can probably put in 3 extruders later, right? At the same time, we will also expand in a gradual manner our upstream processes. So, for example, how much space do we need for corn, rice, corn flour, rice flour, corn grits, anything like that, okay? Related to this. And then also will be the downstream, which is how many more packing machines do we need. Suppose we put in an additional extruder, we need more packaging lines. Then we also need a slightly larger warehouse to handle those. Then we also need more loading bays to be handled. So what we've done in our capital, the way we've constructed it, is we've concentrated on the core. Because if we try to do all this, we might have needed a lot more capital. Okay? So right now, as we scale up, we already have the core intact. After that, we just need to keep investing in upstream facilities and downstream facilities. Upstream facilities, we also, I would include land, a building in that, right? So right now, for example, we think that the land bank that we have currently can certainly take us to maybe about $200 million of turnover, $200 to $50 million. The land bank may not be exactly, right, because over time as we see which locations are on, but broadly, let's say. Now, however, just yesterday at the board meeting, we saw the approval for and got expansion of civil work in this. Now, civil is related to upstream, right? So these are not necessarily brownfield projects, brownfield projects, but they are more like where you're just expanding space in the same plant, right? And that's how we continue to increase, okay? Because we have to balance a tight capital budget along with our aggressive growth expectations, okay? And the third is in terms of all the other expenses. See, basically the other expenses also include manufacturing expenses, okay? And in manufacturing, the most efficient part of our business is the ready-to-cook business, because that's the largest part of our business, okay? Right? So as we have a higher mix this year from non-ready-to-cook, because if you see, our non-ready-to-cook business, I think, grew by about 25% this quarter. You can do, you'll be able to do the math, right? I think last quarter we had called it out also. It was, you'll see it in the headline. I think it was in the region of 25-30% only. So there's been a greater contribution of non-ready-to-cook in our total product mix. Non-ready-to-cook has a higher manufacturing cost, right? Because it's got more depreciation, it's got more processing, it may have more energy because of frying, etc., or oven or baking, etc. So that will also have an influence on our other expenses. Okay, right? And aside from that, I think other expenses also includes travel. So as we called it out in the presentation, I think it's were about 1 crore versus last year's quarter. But I think on a year-to-date basis, our travel expenses have probably gone up by more than 3 crores. Okay? But the answer to your question on versus pre-COVID is that the mix is different. That's all. Okay?
Okay. So can I just add one follow-up question?
नहीं follow up तो फिर अगले quarter में देंगे आपको.
Because it was more related to the first question only.
कोई नहीं, don't worry. We'll try and answer your question. Okay? Thank you.
Just wanted to know.
Wish you all a very, very happy New Year and all the best and wishes to your families, and we'll talk to you in a few months' time. Cheers. Ajay, over to you, man. Cheers.
Thank you. Sir, we have one participant in queue. May we take this one last question, sir?
No, part of that. 3 o'clock close, no? And then it's unfair, yeah. Hai na? Okay.
Right. Sure, sir.
Okay. Please apologize, but we have to get into other meetings also. All right? Okay. Cheers. Thanks.
Thank you. I would now like to hand the conference over to the management for the closing comments.
No, thank you. Thank you, guys. Thank you all, those ladies and gentlemen, for taking the time out to be with us. We appreciate it. And hopefully we are being able to give you all the information that you need. Okay? So have a great quarter and a great year and everything else. Okay. Thank you.
Thank you. On behalf of Anand Rathi Share and Stock Brokers Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.